Hello and welcome to our video on 10 facts you should know before investing in Bitcoin. In this video, we're going to explain everything you need to know about this exciting but risky digital currency. So, if you're thinking of investing in Bitcoin, stick around. 1. Extreme volatility. Bitcoin is known for its price volatility, which means that its value can fluctuate significantly in a short period. For example, in December 2017, the price of Bitcoin reached an all-time high of nearly $20,000. However, by December 2018, the price had dropped to around $3,000, a decrease of more than 80%. This extreme volatility is due to several factors, including its limited supply, the lack of regulation, and the speculative nature of the market. Since Bitcoin is a relatively new asset, its market is still developing, and its value is largely driven by speculation and demand. Investors who are considering investing in Bitcoin should be prepared to handle sudden price changes and have a long-term investment horizon. 2. Decentralization. Bitcoin operates on a decentralized network, meaning that there is no central authority or intermediary controlling the network. Transactions are verified and recorded on a distributed ledger called the blockchain, which is maintained by a network of nodes or computers worldwide. This decentralized nature is one of the key features of Bitcoin and provides several benefits, such as 1. Security. The decentralized nature of Bitcoin makes it more secure than traditional financial systems since there is no single point of failure or vulnerability. 2. Privacy. Transactions on the Bitcoin network are pseudonymous, meaning that they are not tied to a real-world identity. This provides a level of privacy that is not possible with traditional financial systems. 3. Accessibility. Bitcoin can be accessed by anyone with an internet connection, regardless of their location or status. However, the decentralized nature of Bitcoin also presents some challenges, such as 1. Lack of regulation. Since Bitcoin operates outside of traditional financial systems, there is no central authority regulating it. This lack of regulation can lead to potential risks, such as fraud and money laundering. 2. Complexity. The decentralized nature of Bitcoin can make it difficult for beginners to understand and use. Investors should take the time to educate themselves about Bitcoin and its underlying technology before investing. 3. Limited supply. Unlike traditional currencies, which are issued by central banks and can be printed at will, Bitcoin has a limited supply. The maximum number of Bitcoins that will ever exist is 21 million, and as of March 2023, approximately 18.8 million Bitcoins are already in circulation. This limited supply is one of the key features of Bitcoin and has several implications for investors, such as 1. Scarcity. Bitcoin's limited supply makes it a scarce asset, which can increase its value over time. This is because as demand for Bitcoin increases, its limited supply means that the price can rise. 2. Inflation resistant. Since Bitcoin has a limited supply, it is resistant to inflation. This means that the value of Bitcoin may hold up better in times of inflation compared to traditional currencies. However, Bitcoin's limited supply also presents some challenges, such as 1. Price volatility. As demand for Bitcoin increases, the limited supply can lead to price volatility, which can be challenging for investors to navigate. 2. Deflationary risks. Bitcoin's limited supply also means that if demand decreases, the price can drop significantly. This can create deflationary risks, which can be harmful to the broader economy. 4. Concepts of wallets. A Bitcoin wallet is a software application or hardware device that allows users to securely store, send, and receive Bitcoin. When someone purchases Bitcoin, they are essentially buying a private key that is used to access the Bitcoin on the blockchain. This private key is then stored in a Bitcoin wallet, which can be accessed by the user when they want to send or receive Bitcoin. It's important to note that Bitcoin wallets do not actually store Bitcoin itself. Instead, they store the private keys that are used to access and transact the Bitcoin on the blockchain. Investors should also be aware that there are risks associated with Bitcoin wallets, such as 1. Security risks. Bitcoin wallets are a potential target for hackers and other bad actors, and if the private key is stolen or compromised, the Bitcoin can be lost forever. 2. User error. If the user loses or forgets their private key, they may not be able to access their Bitcoin, leading to permanent loss. 5. Transaction fees. Every time someone sends Bitcoin, they need to pay a small fee to the network to incentivize miners to include their transaction in the next block. These fees can be a significant cost for users, particularly during times of high network congestion. Investors should also be aware that the fees associated with Bitcoin transactions can be volatile and can change rapidly based on network demand. 6. Legal and regulatory landscape. The legal and regulatory landscape surrounding Bitcoin varies depending on the country and region in which an investor resides. While some countries have embraced Bitcoin and enacted favorable laws and regulations, others have taken a more cautious or hostile approach. Investors should be aware of any laws or regulations in their jurisdiction that could impact their ability to invest in or use Bitcoin. Some key regulatory issues to consider include: 1. Taxation. In many countries, Bitcoin is subject to taxation, and investors may need to pay capital gains tax or other taxes on their Bitcoin investments. 2. AML, KYC regulations. Many countries have enacted anti-money laundering, AML, and Know Your Customer, KYC, regulations that require exchanges and other Bitcoin-related businesses to verify the identity of their customers. 3. Legal status. In some countries, Bitcoin is not yet recognized as legal tender, which could impact its use and adoption. 7. Risks associated with market volatility. Some potential risks associated with Bitcoin market volatility include: 1. Loss of value. The price of Bitcoin can fluctuate rapidly, which means that investors could potentially lose a significant amount of their investment if the price drops. 2. Uncertainty. The volatility of Bitcoin makes it difficult to predict its future price movements, which could create uncertainty and make it difficult for investors to make informed investment decisions. 3. Emotional trading. High volatility can create emotional reactions in investors, leading them to make impulsive or irrational investment decisions that could lead to significant losses. 8. The technology behind Bitcoin. Bitcoin is built on a complex set of technologies, including blockchain, distributed ledger technology, and cryptography. Understanding these technologies can be challenging, but it's essential for investors to have a basic understanding of how Bitcoin works before investing. Investors should understand the following key aspects of Bitcoin technology. 1. Blockchain. The Bitcoin blockchain is a decentralized ledger of all Bitcoin transactions. The blockchain is maintained by a network of nodes that validate and record transactions. 2. Mining. Bitcoin miners use powerful computers to solve complex mathematical problems and validate transactions on the Bitcoin blockchain. In return, miners are rewarded with newly created Bitcoin and transaction fees. 3. Cryptography. Bitcoin uses advanced cryptographic techniques to secure transactions and prevent fraud. 9. Choosing a reputable exchange or platform. A Bitcoin exchange or platform is a digital marketplace where investors can buy and sell Bitcoin. However, not all exchanges are created equal, and some may be more reputable and trustworthy than others. Investors should consider the following factors when choosing a Bitcoin exchange or platform. 1. Reputation. Investors should research the reputation of the exchange or platform before using it to buy or sell Bitcoin. 2. Security. Investors should ensure that the exchange or platform has robust security measures in place to protect user data and funds. 3. User-friendliness. Investors should choose an exchange or platform that is easy to use and navigate, with a user-friendly interface and intuitive design. 4. Liquidity. Investors should choose an exchange or platform with high liquidity, meaning that there are many buyers and sellers on the platform, making it easy to buy and sell Bitcoin at any time. 5. Fees. Investors should consider the fees associated with using the exchange or platform, including transaction fees, withdrawal fees, and deposit fees. 10. Irreversible transactions. Investors should be aware of the following implications of irreversible Bitcoin transactions. 1. Double spending. Bitcoin's irreversibility is a key factor in preventing double spending, where the same Bitcoin is spent twice in different transactions. 2. Security. Bitcoin's irreversibility also means that transactions are more secure, as there is no risk of chargebacks or reversals. 3. Risks. However, the irreversibility of Bitcoin transactions also carries certain risks, such as the risk of sending Bitcoin to the wrong address or falling victim to fraud. So, there you have it, 10 things you should know before investing in Bitcoin. Remember, investing in Bitcoin is a high-risk, high-reward proposition. Do your research, understand the risks, and only invest what you can afford to lose. Thanks for watching.